Any further delay, let's begin today's event. Once again, traditional lending to non-traditional customers. Sponsored by Factor Trust and hosted by American Banker. I would like to introduce your moderator for today, and that is Mike Fisk. Mike, you now have the floor.
Thanks very much, Christina, and I would like to welcome the audience once again. We very much appreciate that you've chosen to share some of your day with us. We know that your time is valuable, and for the next 60 minutes or so, we will make every effort to make every minute count. Once again, our topic today is traditional lending to non-traditional customers. And my name is Michael Sisk. I will be your moderator today. I've been a New York-based journalist for about 20 years, and I've had stints as investor editor at Red Herring and editor-at-large at U.S. Banker. My articles have also appeared in Barron's, Crain's New York Business, Inc., Institutional Investor, Strategy and Business, and Worth. And I am very pleased to introduce our speaker today. He is Dan Richard. Dan is VP Analytics and Product Strategy at Factor Trust. Dan is responsible for driving strategy, planning, and execution for analytics, product strategy, and data acquisition. He is an expert at leading the scoping, analytical development, and strategic delivery of scoring models and attribute suites for business use cases, including acquisition risk, fraud, direct marketing, account management, collections, and enhancement of high-volume data processes. His industry vertical experience includes auto, communications, retail banking, retail card, underbanked, lines of credit, third-party debt purchase, and collections. Prior to joining Factor Trust, Dan served at Equifax, first as a senior director and a statistical consultant in enterprise analytics. And before Equifax, Dan was a senior project analyst at Scoring Solution. He holds a MS in statistics and a BS in industrial engineering from Georgia Tech. And we are very, very pleased to have Dan with us today. And just before we jump into the real meat of the discussion, a couple of housekeeping items I just wanted to reiterate that Christina mentioned at the very top. We do have time at the end for Q&A. You do not have to wait until the end to put your question in. You can get that question into the queue throughout the hour as it occurs to you, and we encourage you to do that. If we run out of time, which sometimes happens when we've got lots of great content, if we run out of time to get to your question, we will follow up afterward. So fear not, we will either address your question now or soon thereafter, but please get your question in the queue. We would very much like to hear from you. And we also have a couple of polls today, and I always encourage 100% participation. I rarely get 100% participation, but I encourage it because we do share the results with everyone here, and I think it's kind of a nice way for everyone to see where we all stand on the issue that we've come together to discuss. So if you can weigh in, that would be wonderful. And I think actually we are going to kick things off with the very first poll. So let me go ahead and do that right now. And what I will do here is I will read the question, I'll read the answers, and hopefully in that amount of time you will have had a chance to make your selection. So how important is alternative data to your credit strategy? And we've got 5 different selections here. Is it very important? We currently use it to a great extent. Is it somewhat important? We currently use it to a limited extent. Or is it we have tested alternative data and are still exploring how we can use it? Or we plan to explore alternative data in 2017. Or we do not currently use alternative data. So if you could sort of weigh in on that, and it's a nice kind of level-setting question for us as we begin this program today. So I'll give everyone just another moment or two to weigh in on that. That is probably about enough time for everyone. Pretty straightforward question. Everyone probably knows where they stand on that one. So let me go ahead and share the results here. And interesting. So 26.7% of you said we do not currently use alternative data, and then 22.2% said it's very important. 22.2% also said it's somewhat important. So I guess let me kick things over to Dan and ask, do those results, were those what you expected to see, or is there some surprises there?
Yeah, it's interesting, Mike. It looks like we've got a fairly diverse assortment of exposure levels to alternative data amongst our audience today. So that's great. I think we'll find something for everybody here in this presentation. For those already familiar with alternative data, I trust the content that we provide today will only add to your growing knowledge base. But for those still gaining their understanding, we provide today's insights as a way to introduce you to alternative data. And we offer steps to take now to make sure that you're ready. All right, so, and good afternoon, everybody. Today I'll start us off with a brief introduction of Factor Trust, provide a detailed examination of non-traditional borrowers, and touch on the usage of public record data in financial services. I'll then lead us through several demonstrations of how alternative credit data is used by traditional lenders today, and discuss actions that lenders can take now to explore and integrate alternative credit data into their decisioning. And as was said previously, lastly, we'll finish up with an interactive question and answer session moderated by Mike. All right, so to begin, Factor Trust is the alternative credit bureau, a leading provider of underbanked consumer data, analytics, and risk scoring solutions on those underserved by traditional banking channels. We've been serving the underbanked industry for more than 10 years using a contribution model. So all lending customers contribute inquiry and credit data. Our core competency focuses on credit risk and credit marketing, and we provide credit lifecycle solutions for account acquisition, account management, and collections. Furthermore, we were also recently honored as the fastest growing private credit bureau per the Inc. 5000. So we've seen a great deal of growth during our tenure, and it's exciting to grow along with the underbanked consumer data industry as fast as we have. Taking a quick peek inside the credit database, you'll see the types of lenders that contribute to Factor Trust specialize in lending to non-prime consumers. We serve many markets, including alternative lending, auto finance, installment lending, retail finance, credit cards, collections, title, and rent-to-own. We have a reciprocity-driven business model in which lenders pull our FCRA credit data and contribute their own loan data in real time through our proprietary loan reporting process. Our solutions are driven by our unique proprietary data and analytics. Furthermore, Factor Trust has been studying the financial behavior of underbanked consumers for quite some time. In our Underbanked Index, we publish insights about non-prime consumers' earning and borrowing characteristics, such as average monthly income, borrowing frequency, and delinquency rates. For example, in the edition shown here, the bar graph in the lower right demonstrates the significant increase in short-term loan borrowing activity that occurs in the fourth quarter, primarily driven by the holiday shopping season. We've discovered great potential for lenders to leverage these and other insights to enhance their understanding of underbanked consumer behavior. And finally, let's survey the landscape of alternative data types used in credit decisioning today. Factor Trust provides proprietary alternative data solutions in fields even beyond alternative credit data. These include employment and bank account verification solutions and alternative data risk scores. We also partner with other alternative data providers to broaden our solution suite for the benefit of our lending clients.
Hey, Dan, if you don't mind me asking, when the topic of alternative data comes up, oftentimes it's in regards to social media. Can you give a little insight into where that fits into the picture here?
Sure. Yeah, social media data holds really tremendous potential for lenders and other businesses, to both understand their own consumer behavior, but even to influence it to some degree. So things like purchasing preferences, network influence, customer satisfaction, even potential fraudulent behaviors can all be detected using social media data. Now, however, because of regulatory compliance requirements in the consumer financial services industry, a line is usually drawn around data that can be used for credit decisions involving potential adverse action, which is when a consumer is declined for credit. The sources I show on the landscape diagram here are fairly commonly used in financial services, in large part because the companies that provide them are regulated under FCRA, ECOA, and other fair lending regulations. So it's these types of regulated data sources and alternative credit data in particular that will be the main focus for today's discussion. But thanks, Mike.
Excellent. That brings us to our second poll of the day. I think we have 3 today, as I said. So number 2 coming up here. So same drill as before. I will read the question, and in this case, actually, if you could, it's not, you don't have to make a single selection. You can check all the selections that apply in this case. So, how do you use alternative data today? And let me just read through the 6 options here. Credit decisioning, for example, as an overlay to a risk score. For applicant verification, for example, validating an applicant's identity. For servicing, for example, as an alert on risky activity. For loss management, for example, to prioritize collection efforts. For other uses, or we do not currently use alternative data. So if everyone can take a moment and select which of those apply to you, that would be excellent. And I'll turn things back over to Dan in just a moment. Let me go ahead. I think that's probably enough time. Let me go ahead and share results with everyone here. And we got, half of you said we do not currently use data. Those that do, 31.5% of you said credit decisioning is one of your uses, as well as 29.6% of you saying applicant verification. So let me turn things back over to Dan and see what your reaction is to those results.
Yeah, fascinating findings here. See, of the population that is using alternative data today, I see we've got a large share of the audience using it for credit decisioning and for applicant verification, and certainly those are very common uses on the market, and we'll actually be talking about some of the example use cases that we've seen for those as well. So very interesting here. So now let's get the ball rolling with a look at the traditional credit and alternative credit profiles of non-traditional borrowers. First, I'll define the segment of the market at the focus of today's discussion. Non-traditional borrowers are often identified with the term underbanked, which the Federal Reserve describes as consumers that have had a depository account but also used at least one alternative financial service in the prior year. What is an alternative financial service? The classification comprises the many financial services used most often by consumers with subprime credit. These services include short-term loans, auto title loans, and check cashing, among others, and they are not typically captured in traditional credit reporting. Now, a note on short-term loans. Many equate short-term loans with payday loans, which was pretty spot on a few years ago. However, the alternative financial services industry has been undergoing a transformation in recent years, driven in large part by regulatory pressure. Many lenders have transitioned to offering unsecured installment loan products. These generally have APRs above 36%. They're shorter in term than most traditional unsecured loans, so think 3 to 9 months terms. They are originated either online or in a storefront setting, and the loan amounts often range from $1,000 to $5,000, which is between the size of a payday loan and most traditional unsecured loans captured at the big 3 bureaus. So when accessing alternative credit data as the industry continues its transformation, lenders can expect to see more and more of these types of installment loans in their applicants' alternative credit files. Moving on, what may come as a surprise is that most of these non-traditional underbanked borrowers actually have a footprint at both an alternative credit bureau and the traditional big 3 credit bureaus. In other words, these borrowers are not as off the grid as popular perception often entails. In fact, we found in a recent study that 77% of consumers that applied for alternative credit in 2015 had a credit file both at Factor Trust and at a traditional bureau. An additional 19% were not found at Factor Trust, were found at the traditional bureau, and it is possible that many of these consumers were first-time applicants for alternative credit. An additional 2% were found only at Factor Trust, meaning that they had no traditional credit file. For these consumers, their only credit history would be found outside of a big 3 bureau. And finally, 2% were found at neither bureau when they applied for a short-term loan.
Dan, what does it mean for lenders that nearly 80% of the non-traditional borrowers have some or all of their credit history residing outside of the Big Three bureau?
Well, it means a few things. First, that a Big Three credit file will paint only a portion of these consumers' financial pictures, but also these consumers that are active outside of traditional verticals actually have interesting nuances about their traditional credit files. So let's have a detailed look. If we start with non-traditional borrowers' traditional credit profiles, say that 3 times fast, we'll see on average about 13 total trades, open or closed, in their history at a Big Three bureau. To put this in context, in a random cross-section of the full credit spectrum, you'd find closer to 16 to 20 total trades on the average consumer's credit file in the general population. At any given time, about 3.7 of these are open and active. So these consumers, by and large, are indeed credit active in mainstream credit verticals that report to the Big Three. Regarding inquiry behavior, non-traditional borrowers average nearly 5 inquiries in traditional credit verticals in a 12-month period. Here we see a stronger credit hungriness than is usual in the general population. But the most striking characteristic of non-traditional borrowers is in their delinquency profile. Just over half have had a delinquency in the past 24 months, and also just over half have had a collection item in the past 12 months, both signs of subprime and even deep subprime profiles. The credit hungriness, high rates of delinquency, and lower numbers of trade lines interrelate to describe these consumers' borrowing habits. Next, let's layer in non-traditional borrowers' alternative credit bureau profiles. These trade lines and inquiries are unique and additive to what's found at the Big Three credit bureaus. On average, you'd expect to find somewhere between 2 and 3 trade lines in an alternative credit file. You'll also find only a small share being open and active at any given time. This is largely driven by short-term lenders' wariness of loan stacking, in which a consumer takes out multiple short-term loans within a short window of time, effectively increasing the risk that he'll go delinquent on any one of them. Real-time reporting of loan information helps detect loan stacking, as does the common scrub by short-term lenders to check for the presence of an open short-term loan at the time of application. Assessing inquiries, we find that nearly as many inquiries by the average non-traditional borrower are found at an alternative credit bureau as at a traditional one. This is fascinating but not surprising, given the credit hungriness of underbanked borrowers and their potentially greater difficulty to be approved for traditional credit products. It's worth noting that the inquiry dimension of alternative credit data is one where traditional lenders may benefit greatly. The usual SSN, name, address, and phone number are collected on alternative credit inquiries. However, several fields are captured on loan applications in this industry that are not captured in many traditional credit applications. These include employer name, payroll type, and payroll frequency for the lender to understand repayment rhythms, bank account ABA and DDA numbers, since borrowers essentially must submit to automated drafting of loan payments by the lender. Even email address is captured for online loan applications. The consistency and stability of these historical data points on employment, bank account, and contact information are attributed and leveraged as an additional tool in the underwriting applicant risk. Furthermore, non-traditional borrowers exhibit default and collection behavior in their alternative credit profiles too, and the prevalence of these delinquencies compared to a traditional bureau is somewhat in proportion to the number of trade lines found at each. I should note that non-traditional borrowers more often than not demonstrate satisfactory repayment of their alternative loans. And an alternative credit bureau file containing satisfactorily paid loans often serves as an asset to non-traditional borrowers seeking credit. So putting the two pieces together, we see that the comprehensive credit profile is completed by combining traditional and alternative bureau files. On average, a non-traditional bureau's comprehensive credit profile has nearly 20% more trade lines and nearly double the number of inquiries not to mention the rich stability information captured on the alternative loan applications. The percent of consumers newly identified as having delinquencies or collections doesn't rise as drastically, but just as important is all that satisfactory loan payment behavior potentially present in the consumer's alternative bureau file that he or she deserves to get credit for when applying in mainstream verticals. So let's dig deeper into the contents of non-traditional borrowers' credit files. On average, about 9% of these borrowers have an open mortgage. This finding is commensurate with various demographic studies we've conducted of the underbanked population, which indicate that these consumers overwhelmingly are renters. Also, only about 39% of underbanked consumers have an open auto trade found at a Big Three bureau. Again, not surprising given the auto borrowing habits of non-traditional borrowers. We have tended to see a higher rate of buy here, pay here auto borrowing than traditional subprime auto finance among this population, much of which may be driven by difficulty in getting approved by a traditional lender. Buy here, pay here is another vertical that largely operates outside of the Big Three bubble. So just like with alternative credit, the true tendency of auto borrowing is likewise underrepresented at a traditional bureau. About 34% and 26% of non-traditional borrowers have an open bank card or retail trade, respectively. Those that do have open revolving trades tend to have very high utilization, averaging in the range of 95 to 100% utilization, with about a third of these consumers having a utilization greater than 100%. The most common trade type of all to find in a non-traditional borrower's credit file is an unsecured loan, with about 45% of borrowers having such a trade type open at a traditional bureau. An unsecured loan can be a fairly broad definition at a traditional bureau, as it is basically a catch-all for any installment-type loan product not secured by some form of collateral. Thus, they include small or large unsecured cash loans or even student loans. Completing the picture are the unsecured loans in the alternative financial services industry and captured at a alternative credit bureau. About 12% of non-traditional borrowers have such a loan open at any given time. While unsecured loans found at a traditional bureau have the most similar look and feel to those found in the alternative credit sphere, there are certainly distinctions between the two. One such distinction is the average open balance amount. At a traditional bureau, unsecured loans have an average open balance of around $9,400, and that's across all open loans. Whereas in the alternative credit world, balances average about a tenth of that, around $965. Another distinction is that the lenders originating the loans are likely largely different. Many unsecured loans in the alternative financial services industry are originated by online installment lenders or specialty storefront financial services shops that exclusively pull from and report to alternative credit bureaus, not the Big Three. We'll finish out this segment on credit profiles by taking a comprehensive look at the average share of wallet of a non-traditional borrower. What is immediately striking, as we saw in earlier slides, is the heavy skew towards reliance on unsecured loans. This loan type makes up roughly 43% of the open trade lines that the consumer has outstanding and 34% of open balances. To put that in perspective, the average share of open balances on unsecured loans is nearly the same as on mortgages. Again, this is averaged across the entire underbanked consumer population.
Hey, Dan, how would this share of wallet picture compare to that of an average traditional borrower?
Great question. Without a specific data analysis to point to, I'll speak from experience. Typically, you'd expect about 45 to 55% of the traditional borrowing population to have an open mortgage, whereas on earlier slides we saw that in the non-traditional population, that mortgage holders are in the single digits. This aspect alone would drastically shift traditional borrowers' aggregate share of open balances to favor mortgage trades, potentially comprising 80% or more on average of open balances. Again, averaged across the population. Certainly the share belonging to unsecured loans would be much smaller, easily in the single digits. So this really does strike a drastic contrast between traditional and non-traditional borrowers in terms of their share of wallet. I'd like to switch gears here briefly, briefly to touch on the public record profiles of non-traditional borrowers and the role that public record data can play in underwriting these consumers. First, let's acknowledge that public record data can offer a great deal of insight on non-traditional borrowers. For one, these consumers are several times over more likely to have a bankruptcy in their history than the general population. Almost 15% of them do. As well, roughly 44% have a derogatory public record of any kind in their recent past, which can include bankruptcy, judgments, or tax liens. Coincidentally, 44% have also changed address in the last 24 months. And this tendency towards low address stability agrees with Factor Trust's own address stability metrics on this population. One of the strengths of a public record data source is that it can typically capture data points of some kind or other on most consumers, underbanked or not. Even the lack of public records, such as property ownership, in and of itself can be useful to know. And Factor Trust has seen this type of data yield predictive enhancements to its models, particularly through the identity stability characteristics captured via public records. However, an issue we run into in the non-traditional borrower population is the dwindling predictive power that derogatory public record data has when the population is literally flooded with these characteristics. Presence of a derogatory public record tends to be a sharp razor for mitigating risk in the traditional lending space when the percent of applicants with such a characteristic is in the low single digits, and the default rate of the derogatory group is markedly higher than the counterpart group. But with non-traditional borrowers, of whom nearly half have a derogatory public record on file, the distinction in default rates between those with and without such characteristics is nearly non-existent. The value of the attribute is crippled by the sheer magnitude of its prevalence in the population. Complicating matters with public record data is the lack of a behavioral component, as changes to a public record profile occur usually more slowly than changes that occur in a credit file, by virtue of the types of data points being measured. Furthermore, with the context of public record attributes being largely outside of the credit domain, there's little financial insight to draw when attempting to use such data to predict the outcomes of credit transactions. Let's take a look at a few examples. Our first example shows the impact that public record data made in enhancing an alternative credit score designed to predict the likelihood that a lender could recover delinquent debts from consumers that had gone into collections. Within the population of delinquent consumers that were a hit to the alternative credit bureau, which comprised about 80% of the sample, layering in public record data drove about a 6% lift in KS, which was the statistic used to measure the ability to distinguish those consumers most likely to pay versus those least likely to pay. The lift was nice but marginal in light of the KS achieved using a model driven solely by alternative credit attributes. Where the public record data showed the greatest value was in its ability to expand the scorable population to almost 100%, a 25% relative lift in coverage, by scoring consumers that were not found at the alternative credit bureau. However, the predictive power generated when using public record data alone in this population was less than half that of the model driven by credit data alone in the HIP population. There is very clearly a trade-off here between the expanded coverage and the limited predictive power. Our second example comes from an alternative data risk score that Factor Trust recently developed to predict default on short-term loans. For the model development, the borrower population was split into two mutually exclusive regions, hits and no hits, at the time of application to our alternative credit database. Within the HIP population, our alternative credit attributes were calculated off of the consumer's alternative credit history. And in the no-HIP population, there was no alternative credit history available, and thus the attributes were not calculated. Other data sources in the model were traditional credit bureau attributes, checking and savings account behavior attributes, and public record attributes. The results of the model development exercise lent further support to a common theory in scorecard development that like predicts like. In short, when predicting a certain type of outcome, the full breadth of information the credit file offers can be very helpful in making the prediction. However, the past events in the file that are the most similar to the future event being predicted tend to generate a greater share of the predictive power. If you've ever seen the Yahoo Finance articles on what the most important ingredients to the FICO score are, what is always listed as number one? Delinquencies. What is the FICO score designed to predict? Delinquencies. When it comes to delinquencies in a specific vertical, in my background developing credit models, I've seen the phenomenon repeat itself time and again, that behavior from the same industry takes center stage in the prediction. And I continue to see that now at Factor Trust with short-term loans. So it came as no surprise in this model development exercise that within the alternative bureau hit population, the alternative bureau attributes drove about 75% of the predictive power. The next strongest source was the traditional bureau attributes, contributing 14% of the predictive power. Public records in this segment only drove 2% of the predictive power. Turning our attention to the alternative bureau no-hit population on the right, we see the next most similar data source, the traditional bureau attributes, filling much of the void and representing 65% of the predictive power. Public record data had a stronger showing here with 17% of the predictive power compared to the 18% contributed by checking and savings history. To summarize this section on public record data as an alternative data source, we've seen its advantages for expanding coverage and acknowledged its usefulness for identity stability attributes, but the lack of predictive power or similarity to credit outcomes are limiting factors to its usage as a go-to alternative data source. And we'll begin our last section on how to use alternative credit data in traditional lending with a poll question. Mike?
Excellent. Thank you. And here we go. The third poll question of the day and our last one. In what ways might you evaluate or use alternative credit data in your credit decisioning in 2017? And this is another one where we ask you to please check all that apply. So the options here are enhance risk-based pricing, giving rejected applicants a second look, expanding your scorable universe, mitigating losses, or some other use case. I want another moment or two to answer that. Again, the question is what way or ways might you evaluate or use alternative credit data in your credit decisioning in 2017? 2017 will be here very shortly, believe it or not. Okay, that's probably enough time. Let me share results, and here we go. Mitigating losses, 68.2% of you cited that one, and expanding your scorable universe was cited by 56.8% of you. So interesting results here. Thank you so much for participating, and let me kick things back over to Dan.
Yeah, this is really insightful. It looks like a great deal of our audience is focusing their attention with alternative credit data on mitigating losses and expanding their scorable universe. That definitely makes sense. All right, so in this how-to section, several real-life demonstrations of how Factor Trust's traditional lending clients, particularly those in the auto vertical, have used or evaluated alternative credit data for their credit decisioning. We'll actually see at least one example of each of these use cases from the poll question in action. The exact clients and the specifics of their portfolios have been anonymized. Let's begin. So first off, let's cover some basics for traditional lenders about integrating non-traditional credit data into their strategies. There is no one correct way for all lenders to consume alternative credit data. We have clients in traditional verticals using our credit data in a decision tree format, in a dual matrix against a traditional credit score or a custom model, as an ingredient embedded in their credit model, or even as an event-based account management trigger. All are acceptable, and the method of consuming should be tailored to the client's unique strategy and business model. Secondly, traditional lenders should not approach alternative credit data as a replacement for an incumbent traditional credit source. Let me repeat that. Traditional lenders should not approach alternative credit data as a replacement for an incumbent traditional credit source. Just as we saw in the examples a moment ago that like predicts like, if a lender is originating loans in a certain traditional credit vertical, they will need to pay close attention to the consumer's behavior within that vertical found in their traditional credit file, as it has a strong bearing on future performance in that vertical. What the lender should do is view alternative credit data as a critical piece of the consumer's overall credit profile that they are missing out on if they are only using traditional credit. As we saw earlier in our examination of the non-traditional borrower credit profile, these borrowers have very distinct behaviors and financial styles, even when considered within the walls of a traditional bureau. The most effective way to segment and identify these consumers is by querying against an alternative bureau. Finally, we'll see in these following examples some very interesting and profitable interactions between the traditional and non-traditional bureau world. Let's begin with an example from a full-spectrum auto lending client who has 3 credit grades defined by traditional credit characteristics, and the highest tier here represents the best risk level of the population. We found that the hit rate to the alternative credit bureau within this best risk population was the lowest, about 3%. To contrast that, the hit rate in the worst risk grade was 10 times that, at 32%. The key finding in this study was that the loss multiple driven by the alternative bureau hit in the highest tier was 7.7 times. We calculate loss multiple as the ratio of the bad rate in the alternative credit hit population divided by the bad rate in the no-hit population. In this case, the bad rate in the hit population was 7.7 times the bad rate in the no-hit population. In fact, the bad rate within the alternative credit hit population in the highest tier matched the average bad rate in the middle tier. So for this auto lender, even with alternative credit hits generally having such a subprime behavior about them, due to their pristine performance at the traditional bureau, a top-tier hit did not necessarily mean a decline. What it meant was a right pricing opportunity, wherein alternative credit hits in the highest credit tier could be repriced with middle-tier components of LTV, term, APR, stipulations, and amount financed to assign the appropriate risk-based pricing to the applicant. Pretty simple example, but let's move on to a slightly more complex use case, the decision tree. For a different full-spectrum auto lender, alternative credit data was assessed both within the approved population and the declined population. Within the declined population, FactorTrust conducted reject inferencing using an industry-standard parceling technique to infer what the risk likely would have been had the declined applicants actually been approved. For both approvals and declines, markedly lower risk and higher risk subpopulations were identified using alternative credit data. The first opportunity identified was a right pricing opportunity within the approval population. With alternative credit data added to the mix, the auto lender discovered the potential to increase the volume of a lower risk credit tier by 26% through swapping up approvals from a worse risk tier. Now, these are all approvals. Consumers in the swap-up group demonstrated positive short-term loan performance and solid consumer stability characteristics within their alternative credit file. To the lender, this swap-up opportunity presented the potential to expand their business with this swap-up group, as the lower risk tier offered more flexible LTV requirements, lower APRs, and hence higher conversion rates of the borrowers offered these deals. The risk level of the loans were also indirectly improved by the more favorable pricing that the swapped-up consumers received. It was a win-win. The second opportunity was a right pricing swap in the opposite direction, wherein the lender was able to identify a consumer group that had a 3x loss multiple between the hit and no-hit populations to alternative credit data. This swap was similar to the first example in that the lender was able to still approve the consumers, but with the deal structure that was the most appropriate, given the true risk profile of these consumers. This swap was only made possible by layering alternative credit data into the traditional credit framework. The final opportunity involved a cohort of applicants within the traditional credit decline pool that had markedly low risk profiles when assessed with alternative credit data. Again, positive repayment performance and solid stability metrics merited these consumers a second chance. Giving these rejected applicants a second look yielded the potential to increase the volume in the lender's lowest approval grade by 12%.
So Dan, what you're saying here is that the information found in an alternative credit file has potential to adjust a lender's decision up or down based on risk. Is that right?
Yes, exactly. Just like with a traditional credit file, an alternative credit file contains information on satisfactory and unsatisfactory payment on loans, inquiry frequency, balances, high credit amounts, etc. These alternative credit characteristics, along with stability and employment characteristics, have great potential to adjust the lender's ultimate pricing or approved decline decision to a higher or lower tier of the decision strategy. So let's move on to a more complex strategy that involves an auto-client dual matrixing a traditional credit score shown along the y-axis with an alternative credit score shown along the x-axis. So before I get started with the demonstration, it'll behoove me to describe this very colorful landscape that we painted with the subprime auto-client in question. First, note that the traditional credit score along the y-axis did have some traditional credit unscorables, meaning that there was either no footprint at the traditional credit bureau, or else that footprint was so dainty that it held insufficient information to actually score the consumer. Next, the traditional and alternative risk scores were both split into deciles, wherein decile 10 is the best risk decile, and decile 1 is the worst risk decile. Next, note that throughout this matrix were approved, rejected, and booked accounts. The traditional credit score in the y-axis was used as one element in the decision strategy alongside low side and high side overrides throughout the matrix. Approvals tended to be ranked higher and rejects tended to be ranked lower, but a sizable mesh of decisions and booked good and bad outcomes for this very large subprime auto client exists throughout this matrix, which validates our analysis with a minimum critical sample size no matter where in the matrix we choose to look. The numbers in the matrix describe the ratio of the default rate in the specific cell to the average default rate of the entire row. Let's walk through an example. To demonstrate, let's say that the default rate of the entire traditional credit unscorable row, the top row, on average was 30%. It wasn't, but I made that number up purely for demonstration purposes. Then, armed with the understanding that the value of each cell describes the ratio of the default rate of the cell to the default rate of the row, we can see that the default rate of alternative risk score decile 10 within this traditional unscorables row was 16.5%, or 0.55 times the 30% row average. Similarly, the default rate of alternative risk score decile 1 in the traditional unscorables row was 45%, or 1.5 times the 30% row average. And just for good measure, I'll run through one more row. Let's consider the bottom row here. Let's say the default rate of traditional credit risk decile 10 was 10%. Again, it wasn't, but let's pretend it was. Then the default rate in alternative risk score decile 10 would have been 6.5%, or 0.65 times the row average of 10%. Furthermore, the default rate in alternative risk score decile 1 was 18.8%, or 1.88 times the 10% row average. In this way, we can see that there are certain cells within the traditional credit no-hit population that had lower default rates than cells within the very best traditional credit score decile. But these were only revealed when alternative credit data was considered. So let's walk through the opportunity areas of this matrix. First, the client found a definite loss mitigation opportunity in the matrix. For those consumers still being approved within the highest risk traditional credit deciles or within the no-hit population, having a poor alternative risk score confirmed that these were accounts best declined. The losses averted in this portion of the matrix easily outweighed the few good accounts that were sacrificed. Next, in the middle and upper tiers of the traditional credit spectrum, the client found significant right pricing opportunities. For consumers in the best 3 alternative credit deciles, these consumers could be graduated into better credit grades with more favorable pricing, conversion, and outcomes. For consumers in the worst 3 alternative credit deciles, these consumers could be right priced into a higher risk tier that would still yield an approval decision, albeit with loan terms and stipulations more appropriate for the heightened risk level of these consumers. Finally, the client found some universe expansion areas of the matrix where approval criteria could be relaxed for applicants that demonstrated more favorable alternative credit profiles. Each of these adjustments to the subprime auto client's decision were made possible only by considering alternative credit data in the decision process. All right, the last example will demonstrate the usage of alternative credit data for account management purposes. Consider the most simple of events involving alternative credit data: first-time entry to the alternative credit universe. When Factor Trust conducts a data test for a client, one of the first steps we take is to assess the alternative credit hit rate of the consumers in the sample, both at the original application date, but as well during the time between the original application date and the time of the data test. In the example shown, the applicant population of the full spectrum auto client demonstrated a relatively subdued 12% hit rate to the Alternative Credit Bureau as of the time of the original application. These applicants demonstrated a default rate that was 2.4 times higher than consumers that had never entered the alternative credit universe. However, in the ensuing 24 to 48 months between the initial application date and the date of the retro study, an incremental 18% of the borrowers in the sample hit the Alternative Credit Bureau for the very first time. These were hits that only entered the alternative credit universe after the initial loan decision was made. Interestingly, the default rate of the borrowers that entered the alternative credit space after initial loan application was 2.2 times that of those that never entered the alternative credit space. This event of entering the alternative credit universe for the first time can be extremely powerful to traditional lenders. Armed with this information and other event-based triggers that Factor Trust captures, the lender could have taken specific account management actions to mitigate losses, such as prioritizing collection efforts when borrowers in this group went into delinquency. We'll finish off this how-to section with the big takeaway that traditional lenders should tailor their usage of alternative credit data according to their traditional risk bands. We've seen that applicants with traditional generic risk scores above 700 tend to have low hit rates to the alternative credit sources, but the loss multiples for these applicants tend to be the highest. A hit to an alternative credit bureau should not necessarily mean a decline, but more often a right pricing opportunity. For applicants with mid-grade traditional risk scores, expect a moderate alternative credit hit rate and loss multiple. We've seen right pricing opportunities here where lenders can go beyond simple hit and no-hit classifications and begin using the information contained within the alternative credit file for basic hit plus and hit minus ranking strategies. Loss mitigation also becomes a possibility in this mid-grade traditional risk band, as high-risk applicants could be declined to avert disproportionate losses. Finally, the higher risk grade traditional credit tiers, generally below a 600 score, will most often see the highest overlaps with the alternative credit universe. The high hit rates tend to diminish the pure hit versus no-hit risk differentiation, but they also open up the potential for the content of the alternative credit file to drive significant differentiation. More advanced grading using A through F risk grades or alternative credit scoring models enables advanced decisioning strategies. As well, lenders operating in this space could see opportunities for both universe expansion and loss mitigation as swap ups and swap downs become increasingly more equally likely. So we'll close with a summary of actions that traditional lenders can take now to discover, evaluate, and implement alternative credit data into their decisioning processes in 2017. We recommend that traditional lenders begin by conceptually exploring the universe of alternative credit data, and webinars like today's are a big part of that. Learn what providers are out there, the nature of their data, and hypothesize how it could help you achieve or exceed your 2017 performance goals. Next, traditional lenders can diagnostically evaluate the power of alternative credit data through retro tests on their historical portfolios. They may conduct such tests on traditional credit data today with the help of the big three bureaus, and FactorTrust offers the same robust retro scoring capability of its alternative credit data. Lenders will unearth insights about which aspects of applicants' alternative credit histories are most correlated with positive or negative performance outcomes in their unique population, and our in-house analytics team of top-notch statistical consultants collaborates with lenders to design and conduct the analysis, and we help lenders interpret and quantify how the results tie back to their bottom lines. Finally, after determining where and how alternative credit data should be woven into their decision strategies, traditional lenders should proceed to implementation. The technology component of this process can sometimes present a bottleneck, and the timing of the implementation stage oftentimes can be very long. To help ease the burden, FactorTrust's experienced customer care team actively helps lenders integrate directly via our API. Alternatively, lenders can call their traditional bureau representative to ask them how they can access FactorTrust data through their platform in 2017. That concludes the presentation content today. I'd like to thank you for your time, and at this time I'll pass it off to Mike to moderate our question and answer session. Mike?
Excellent. Thank you very much, Dan. And as promised, we've got about 4 or 5 minutes here for questions. And I think we should probably just get right to it. So let me take a look here and kick things off with this question. Does FactorTrust have any information beyond credit data that I can't get at a traditional bureau?
Absolutely. As mentioned earlier in the presentation, the consumer stability data we capture comes from inquiries that are off the traditional grid. We also capture and attribute more fields than the big bureaus typically do. These include bank account numbers and stability of the bank account numbers that a consumer is stating, stability of their email addresses, even for online applications, stability of their IP addresses. So the same goes for stated employment and income data, ACH performance, and banking relationships. Great question.
Thank you. Thank you. All right. Good. Let's see here. Next question. What kind of fields does your alternative trade line data include?
Yeah, good question. All right, so we have application inquiries, loan performance data, consumer stability data, employment and income data, and that's stated employment and income, not verified. Within the trade line segment, you'll find the typical fields that a traditional bureau has around open dates, high credits, credit limits, balances, delinquency statuses. But given the nature of the loan products in our industry, we also typically see greater detail on the individual ACH payment events and dollar amounts, which, as I said earlier, which bank accounts they come from, but as well the return codes that the banks send back when payment is attempted. So information captured on inquiries as well lends itself to deep insight into consumer stability, again, around address, phone, email, bank account, and IP address.
Okay, great. And let's see, here's a good question. You may have touched on it already, but what are the sources of FactorTrust's alternative data?
Yeah, good question here. So our data is contributed by our lending clients. We have, just like at a traditional bureau, a reciprocity-driven contribution model. So in other words, it's give to get. Clients that pull our data for decisioning, report their loans and performance to us on the back end in real time. So as well, our clients come from several verticals, including short-term loan, subprime auto, installment, title, virtual rent-to-own, and subprime credit card.
Understood. Okay. All right. Wonderful. See here. Just about getting to the top of the hour, but I think we have time for another question or two. What kind of coverage does FactorTrust have in the alternative data space?
Yeah. So the FactorTrust Alternative Credit Database excuse me, contains over 22 million consumers and counting. So we see roughly 500,000 new unique consumers entering our database per month. It's definitely a growing, fastly growing database. And within our credit database, we have over 225 million transaction records for these consumers. So definitely a lot of activity that we are capturing. And so, yeah, it's very exciting to be part of such a growing industry, but as well a growing company with a growing database.
All right, wonderful. Let's finish up with this last question. How is FactorTrust alternative data regulated? Yeah,
so FactorTrust's consumer credit data is FCRA and ECOA compliant. Our consumer credit report contains all of the raw detail about trade lines, repayment performance inquiries, et cetera, that feed into the credit attributes. And we are, as I've said earlier, we are a credit bureau with all of the same regulatory compliance responsibilities that the big three bureaus have regarding consumer dispute and disclosure.
Excellent. And you know what, let me just, since we've got a lot of people still with us, let me just slip in one last question if you don't mind. Do you collect single payment loan payday repayment data? Traditional CRAs don't collect it, do they?
Yeah, so we do collect single payment loan data, payday loan data. This type of data is not typically found at a traditional credit bureau. There are some different reasons for that. Some part of that is that with payday loans, the payment frequency is such that, within a single month you might find, 2, 3 potentially payments on a payday loan. In the traditional credit sphere, the Metro 2 format is generally captured in a monthly format, and it's set up to capture monthly type of information, and the lenders that are reporting that information generally report it monthly. So the payday loan is kind of a different animal than what you would typically find at a big bureau. There also comes with it, I think, somewhat of the stigma, of that type of loan product that, certainly some of the traditional bureaus in the past may have, viewed as not attractive to them.
Okay, great. Let's see here. There's one more question I really would like to ask before we let everyone go. There's a few minutes past the hour, but let me just ask, see if you can, how quickly you can answer this one. Does FactorTrust model also offer an aggregation of overall risk profile using both traditional and alternative reporting tools, or is it up to the lender to figure out how to blend or assess the two sources for their specific credit decision parameters?
Right. Yeah, great question. So FactorTrust has developed blended scores and blended attributes, combining traditional and alternative credit data together to get at the kind of combined characteristics. We saw earlier in the slides the combined credit profile, and we've seen value there in combining these two together. So we do offer such solutions. Our research and development team in analytics as well is frequently researching these types of use cases, and certainly we pay close attention to the needs of the market and to our clients in terms of assessing where we see an opportunity to blend credit data from the two worlds together.
Excellent. Thank you, Dan. I think that's a nice note to end on. We're a few minutes past the hour, but I appreciate everyone in the audience hanging with us for a few minutes because we had a couple of great questions come in there at the very end. Let me, first of all, thank Dan for a great hour of discussion, great content, and again, thank the audience for being here with us and for asking all those great questions. Please keep an eye out. We will be sending you an email in the next couple of days that will have a link to the recording of this program and also to the slides themselves that you can review at your leisure in the future, and lots of good content here, so we encourage you to take another look when you get that email. And with that, I'll wrap it up. Wish everyone a wonderful rest of the day, and I hope you'll join us again here very soon. Thanks so much.